All right, welcome everyone. Welcome to the Hurley Investments Market View Commentary for the 13th of November. Tonight I want to go through a couple questions that you guys had, and we'll just make a couple comments on it. The first question was, and it's kind of simple, right? How important is the Moody's downgrade of the U.S. government debt? That's really what it comes down to. How important is it? Because basically what we've gone is from AAA to AA plus. And this is not the first time that this has happened, because we had Fitch go through it and mention that well, we should have learned from past history. That's what I'm trying to say. Past history is the US is still good enough that it doesn't matter. Now, it's not like we rose a lot today, right? I believe it was 0.8. I'm trying to get my phone to work for me so I can tell you accurately. Pretty sure it was 0.8. We were actually down 0.8 today. So we lost 0.08. So we were down. And it's funny because Ma just typed in, no one learns from past history. I want to agree with you in regards to the stock market, but I do think people pay attention to past history. I think that's the whole premise of the education system and the stock market, that you learn from your mistakes and you don't make those same mistakes again. Unfortunately, we live in a variable market. You may have made the same mistake on a trade in the past that you lost money on, and you will most likely lose money on that same trade in the future because the circumstances are going to be different. And those different circumstances are what makes investing so difficult. So we now have 2 of the 3 main rating agencies that give us a AA plus. Fitch's was because fiscal deterioration, increasing in debt burden, and political standoffs on fiscal debt issues. Basically, what they are politely trying to say was our political leaders are a bunch of idiots. Democrats, Republicans, across the board, we have a bunch of idiots that are managing our country. The debt ceiling should never have been a political ploy, but the debt ceiling also should never have been raised. Stay within your freaking budget. It's that simple. So we have 2 of the rating agencies that have us a AAA plus. I'm going to ask you guys, what country would you rather see your money sit with if you were trying to get a return that you felt was guaranteed or protected? What other country would you like to see your money with, other than the US, that you'd like to see your money grow that'd be mostly protected? So we have a Norway. I would kind of scratch my head on that one, but there you go, Switzerland. The only one that you could really say has the protections and the value of your account being protected and getting that money back would most likely be Switzerland. Maybe I'm missing something on Norway, to be honest with you. But the only one that I knew of would have been Switzerland, because you can't let other countries come in and take it. It's relatively protected. It has good history of paybacks. Had a girlfriend that lived in Norway for a couple of years, but I don't know. I would have said Switzerland. So that's just something to understand. Our market was up, down, and up again in the pre-market. We were down as much as over 0.5% in the pre-market, and our market did a pretty good job of shaking it off. That's the best way to say it. Just so you guys know, the Dow was up 0.16. Anyone know why the Dow was up today? Anyone know why the Dow is up today? Boeing, that's right. Boeing got a $52 billion 99 plane order in. So Boeing helped the NASDAQ be up today. Excuse me, helped the Dow be up because it's only 30 freaking stocks. So there's the short and the skinny right there. I found an interesting article, and let me ask this one. Does anyone remember the 2023 S&P 500 estimated growth? This comes in a dollar figure. What the estimated growth in general is supposed to be for the S&P 500. Anyone know what it was? No one wants to take a stab at it, huh? And I should say an earnings growth. So let me go ahead and let me put that in here. So I'm going to say earnings estimated growth. No idea. So an 8% would be good. So it's supposed to be a 5% growth, which would have put it right around 238. Earnings of 238. So I just noticed this as it came across. I think the feed comes through CNBC. You see where it says 3 hours ago, and it just says things you need to know about, today. S&P earnings per share have proven resilient, growing for the first time this year, or growing for the first time since this time last year. So we had negative real growth on S&P 500 earnings year over year. Earnings per share grew by 4% and was up 10%, excluding the energy sector. But the analyst had he maintained his S&P 500 earnings per share forecast of 224 in 2023, representing 1% year-over-year growth, 237 in 2024, representing a 5% year-over-year growth, and 250 in 2025, representing a 5% year-over-year growth. I find it interesting because the S&P 500, I believe if you can go back as far as 8 years, just hasn't grown. It's the real earnings are just not there. We're not growing. The real returns for those S&P, this is the first quarter in a year that the earnings of the S&P have grown year over year. And you can go back to 8 years. What's scary, at least I think it's scary, bigcharts.com. We want a basic chart of the SPX. We're going to go 10 years. And if we want to mark that 8-year growth rate, it's right here. We've gone from 2000 to roughly 4,500. It's not there right now, but we've went 125% S&P 500 stock market growth with a real S&P earnings growth rate of 8%. So let's work those numbers really quickly. And here is the question. Layout 0, 0. Do you think 8, and I'm gonna give you a range of 15% real 8-year growth should equal 125% S&P 500 stock market growth? Yes or no? Of course not, right? So what does this equal? What does this spell? If you're looking at something like this, what do you think in regards to stock market? I'm looking for a specific word. Stupidity is not the word, but yes, that's only one less than 2% per year. Correct. Which is where we're trying to get our inflation to, right? S&P 500 companies' real growth of their businesses is not keeping up with inflation. But we already used the word stupid. I'll just tell you, I mean, when I think of this, I think bubble. And that's where I think you get one of these stock market crashes that represents a 2008. because you've had all this growth on zero real growth. And that makes me worry. Last question. I got this from a couple different people. Where is it? Here we go. All right, let me get a couple things correct. The question is, why don't we go to cash? But the prior question, which is more important, at least it is in my opinion, the prior question is, what is the caller trading methodology? And that is making up downward movement, converting the profits to more shares, exponential growth. Well, can't spell and I can't see behind my GoToWebinar. Can't spell because I can't spell, right? Exponential growth when they come back. And now the question comes to, though, what does that look like? And it's funny because we have a couple different thought processes here, and I'm going to use it in green. Some of us think the stock market or the cycles work like that, right? They go down. Jim, I'm going to make that comment, but I'm going to keep that quiet for right now. We think the stock market looks like that, the green line. Peaks and troughs. Some people use that stock market cycle as a circle. And the S&P 500 earnings look like this. They head down, they trough, they come back up, and we basically haven't even met inflation, right? Some people think cycles, and I find this one interesting. Some people think cycles look like this. And they'll go to any of the great businesses that we've had. Every great business cycle looks like that. And you can use the Rockefellers for oil. You can use Morgan Stanley, Bear Stearns. You can use a lot of the .coms that burst. I don't think you'll see Apple like that. But that is what someone made the comment to me about. And not only that, that comment was made by a Harvard graduate. Kevin, that is what a business cycle looks like in the US for any of the great companies. Then the last one, they put along, huge upside, then they plateau and grow, huge upside, then they plateau and grow, huge upside. So if I was going to ask you, which one of these do you like? Actually, which one is a business cycle that you can relate to with stocks? Do we have the upward moving trough? Do we have the circles? Do we have the jagged down, or do we have the plateau? Which one works for you guys? Which one has been your experience in the stock markets? Stuart and Mark are both telling me the last one, the plateaus. William thinks it's the circle one. Ooh, our doctor said it's the combination of all. Jim says the plateau. So dang it, Maud, here I was going to be really thoughtful for you guys, but the fact of the matter is, I think they all can relate to certain stocks. And I will agree with you that sometimes, to me, it seems like the troughs keep heading lower. So the problem is market timing doesn't work. I got this from the Visual Capitalist, that if you were to simply miss the 10 best days in the market, you would have lost over 50% of their end portfolio value. And they compared, these things or what have you. Making matters even worse, if you miss 60 of the best days, which is technically something like 33.3% of the up days in the market, you would have lost a striking 93% of the value of your portfolio. And then they talk about, and this is where they lose me, right? Overall, an investor would have seen almost a 10% average annual returns using the buy and hold strategy, but we all know averages don't mean anything. You can show an average for 13 years of this great return and still not have made a dime on the S&P 500. Averages do not equal portfolio growth. And then someone made the comment, well, Kevin, don't 90% of people lose money in the stock market? And the Money Show, which I happen to be a participant of for some years back, and I got to speak in it for a couple of years, right? The Money Show lets everyone know that, hey, based on several stockbroker studies, yet we can't find exact ones, as many as 9% of traders are estimated to lose money in the stock market. It can be even higher failure rate if you look at day traders, forex traders, and option traders. So it comes down to, and I think what people are asking comes down to this: is it worth the risk? And people are asking that right now, especially in regards to the fact that the 60-40 portfolios really bit the dust. I'm biased, and some of you have sat with me through some years and had some great returns. I'm biased though. The short answer is, as you get that up and down movement, the opportunity to make it big hangs on one stock. One stock moving and one stock moving significantly. 90% of Warren Buffett's portfolio is in 5 positions. And unfortunately, as Apple keeps getting bigger, he will feel like he has to keep selling off some of his Apple, which will hinder everyone else's growth in the world on Apple. I think that happens when you have like 138 million shares of Apple. But is it worth the risk? Absolutely. If you're protecting with options. And the reason why, that saves you from stocks losing 50, 60, 70, or 86.6% of their value. Now, fact of the matter is, you don't predict or guess where the stock market's going. The timing is just not there. And it's funny because the big picture came up with, he doesn't know what to say. I like the guy, but we had gloom and doom for a month. But what it all means, consumers are facing their fair share of challenges, but we've had a measure of relief at the gas pump. I disagree. I've got a diesel car. So unleaded gas has come down roughly 55% here in Utah. At the highs, we were paying about $4.55, and that gas is now down at $3.02 today. So unleaded has lost, I guess that's not 50%, that's 33% of it's gone down. Now, on the flip side, I'm still paying $4.25. Boy, I wonder if that is close. As I'm doing my math now, it sounds different. I was paying as high as $4.80, $5.80, excuse me. $5.80, let's run some quick numbers here. $5.80 minus $4.25 is $1.55 divided by $5.80. 580 minus 425, $1.55 divided by 580 is 26%. So I'm off on you guys by about, anywhere between 7 to maybe 10%. But yes, our gas relief has been helpful. Homeowners have a lot of value in their home, but the numbers of buying homes are pretty pathetic. And here's what I'm going to say. If you own a home that's over $455,000 that puts people in jumbo home loans, right now, they're selling at a very, very meager to next to non-existent rate. Those more expensive homes that require jumbo loans are out of most people's capability to purchase, or their desire to purchase at a 8%, at an 8% mortgage rate right now. It's just not available. Not to mention, someone like me got in, had to refinance, had a jumbo loan. I got mine down and cut 3 years off of my time to pay off my mortgage and moved it down to a 2.75% interest rate, which means, which really means for me, my next house, I have to take the profits out of this one and I've got to invest it, which, basically simply means I'm going to have to go find a house or a piece of property that I can invest somewhere between $800,000 to $900,000 in, so I don't get taxed on it. And it has to be what I want, and it has to be, near work, have internet, blah, 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 blah. There's a lot of wants, right? But it just doesn't look like those amount of properties are available. If I get to sell mine way up high, then I'm going to have to find another one way up high that wants to sell like I want to. And it's just not out there right now. The uncertainty of where our economy is going and the uncertainty of the stock market, interest rates, I mean, the whole 9 yards, it's just not there. We don't have confidence right now in mortgage lending. We don't have confidence in the stock market. We don't have confidence in our government, the FOMC. There's no confidence anywhere in regards to what's happening. I think people are hunkering down and they're not looking to be spending their money. They just went through COVID, went through some hard times. You better like where you're living right now, because that's kind of what you're going to be stuck with for at least the next 2 to 4 years, based on the cycles of the housing market. If you ask me where our markets are going to end, I'm going to say higher. I'm just following the trend. Pretty interesting. On the Dow, we're bullish and we're just breaking above that base that I thought we would be making. Wouldn't surprise me to see it come down. We probably have a week and a half or more of building this base to make a little run higher. S&P looks exactly the same. 1 day higher. We have a doji today, probably coming back down to continue to build that base for another week and a half. Pretty close on the NASDAQ. We don't quite have a doji on the NASDAQ, but no, it's not building a base as nice as the S&P 500. Probably looking at 13,528 as the base that the NASDAQ has to build to see itself then moving higher. Kevin, what is the base again? That's just where you see a rebalancing of positions before you head higher. And we're probably doing a rebalancing of positions right now. You might even see the rebalancing or our Christmas rally happen in November, although that wouldn't make sense, because if the rebalance is now, then it allows you to go higher in December. So that would actually justify the opportunity for a Christmas rally. If we look though for a Christmas rally, the problem is in December, so I'm going to my folder, in December 13th, Wednesday, December 13th, FOMC rate decision, and we could see another quarter point higher. I'm going to tell you, I don't know what the Fed's going to do. They missed their opportunity in lowering, they missed it in raising it. They can't get much dumber. He seemed to do better at the Jackson Hole conference than he did speaking, and this is about Powell, than speaking at the conference after. So who knows? Who knows? We have the too close to Christmas to do anything. That I would typically agree with you. But again, we're not dealing with the sharpest tool in the shed, is all I'm going to say. All right, earnings. Home Depot on Tuesday, Wednesday, JD, Target, TJ Maxx, Cisco, Palo Alto Networks, Thursday, Macy's, Walmart, Beazer Homes, Gap, Ross Stores, and Alibaba. We're starting the first week of 3 weeks where we're going to get the retail sales numbers out of the retail sales S&P 500. It should be good. It should be good overall. In fact, unfortunately, it should be so good that with the sales and the fact that consumer spending was slightly down today on a CNBC survey, it doesn't really stand for anything. It really doesn't mean anything. But on the CNBC survey, it looked like people were pulling back a little bit on their consumer spending. Again, it's just one survey. I think there were only 1,000 people that were surveyed. So it really, if it's not going to be 30,000, it's really not an accurate polling of consumer spending. Economic report's pretty quiet this week. Trade balance, consumer credit tomorrow. I've got an article on consumer credit on how high it is. MBA and wholesale inventories on Wednesday, initial continuing claims on Thursday. And actually, the reason why this doesn't look so good is because I didn't change it. Let me go ahead and make this. As the Treasury budget was today. Of course, it's going down because they are selling off. This was last week's. We have CPI and core CPI numbers tomorrow. This is the inflation number week. PPI and core PPI numbers. We have the Empire manufacturing numbers. We have retail sales, and we have retail sales X autos. And we finish up with business inventories. I was going to say I knew that looked different. That didn't make a whole lot of sense. Thursday, initial and continuing claims. We have import and export numbers, which are really non-important. We have the Philly Fed number, really supposed to be down. Capacity utilization, which again will also utilization, which again should also be down. Industrial production. A lot of you people asked, why would industrial production numbers be down? Because they've already made their Christmas product. So that's why industrial production should be down. And then we have the NAHB housing price index. Last but not least, on Friday, building permits and housing starts. Wow, I spelled permits really weird. So good question. In fact, and I still got to go back to Jim's comment. And Jim, I haven't forgotten. What are you expecting for CPI and PPI? Fuel is down, gas prices are down, and you're looking at sales going into Black Friday and even earlier. They should be relatively tame. The CPI numbers are supposed to be 0.1 and 0.3 for core. That seems better than 0.3 and 0.5. The PPI numbers on Wednesday, 0.1 and 0.3, same thing. PPI 0.1, core 0.3. I would expect them to be low and in that range because gas prices and sale prices of products are usually cheaper going into this part of the year. It's just, it's everything's on sale. Black Friday is coming up, Cyber Monday. I'm already seeing things for sale that are out there. So that's what I would expect. More so in the Targets and Walmarts, their sales were not very good over summer, and you're seeing some of their summer inventory on clearance right now. And our Walmarts, shocking, right? Shocking that Crocs, aisles of Crocs are right now, and I guess it's their knockoff version of Crocs, are clearance price because no one wants to wear Crocs in the snow out here. It's getting cold. So I would think we'll have pretty tame, if not better than expected, CPI and PPI numbers, but it's mostly related to seasonality and our gas prices coming down. With that said, China's biggest shopping festival is set for a tepid season, is the best way to say it. I wouldn't say 2023, just a tepid season. A very interesting article for those of you who are trading Alibaba with their earnings on Thursday. Pretty neat. Texas Instruments, and that's what reported today, TSN. Texas Instruments breaks ground on the single economic investment in Utah. It's a it's $11 billion semiconductor wafer fabrication plant. Now we have Flash Technologies out here that purchased their business from Samsung. So we already have hundreds of thousands of plant space or manufacturing space available. They're really just buying and retrofitting Flash IM's old investment, and it's funny because they're not really creating 800 new jobs, they're just replacing those jobs. The neat thing is out here we have a pretty big Adobe. I don't think it's the headquarters, but we have a pretty good Adobe building out here. 3Com is out here. Microsoft is out here. And there's one more I'm missing. But we do have some pretty big technology buildings or amounts of people out here. Okay. The golden path of huge drop in inflation without a recession is still possible. I disagree with this. Someone actually asked me, why do you put stuff in there that you disagree with? I'm trying to be, is it bipartisan? I'm trying to be bipartisan. I'm trying to show you both sides of the equation. I don't agree with this. I do not see a soft landing. I don't see a no recession possibility. But the numbers can work out. So I give you both sides of the story so that you guys can make your own judgment. So you can go online, myhurleyinvestment.com, look at these, look at the notes, get the notes, see what you think. That's why I put it in here. I'm trying to give you guys both sides of the story being as non-partial as I can. My numbers can't get here, but his numbers do, and there's not necessarily, it's close enough that yes, he could be correct. All right, article, credit card balances spiked in the third quarter to a $1.08 trillion record. Holy crap, are we in debt? And it's interesting, I could pay off all my credit cards in 2 months. I can't pay them off all up front, but wow. Some of the interest rates that are out there, if paying your credit card off is not important to you, it needs to be. But this will be the red flag that recession is coming. When you see defaults on credit card payments, which when you have over $1 trillion, our previous high I thought was 854 billion. When you see people living on credit like this, Houston, we have a problem. This is an issue. And this will stifle consumer spending. It'll stifle it because we're going to spend the whole rest of the year paying it down or paying it off. Scary. Absolutely scary. All right. Disney expands cost-cutting plan by $2 billion. Fact of the matter is they got to get their movies up to par again. Again, Iger's taking all of the right steps. Their earnings were fabulous, but it will take more than what he's done so far. Mortgage rates plunge, which they didn't really plunge, but we did get an uptick in demand for new mortgages. Where is it? Mortgage rates decreased to a 7.61 from a 7.86, and they were as high as 8. So we are down 0.39%. We're not even down 0.5% from the 30-year highs. But look at the title, mortgage rates plunge. When I think of plunge, I think they lose half of their value. No, they went down from 8% to 7.61, a 0.39, 0.4% over a 4-week period. I don't consider that a plunge, but we got a 2.5% uptick in mortgage applications. Very interesting. Parents lining up for a $2,500 full body MRI scan that can detect cancer early. I scratch my head on this one. I don't know. I think of what's her face with the finger prick and the blood that they can tell all that stuff. Kind of disagree with that one, but I found it very interesting. And there's the Boeing news that came out today for their new planes. Someone made a comment, and I want to go back to it because it was pretty important. Could that 8% to 15% growth 100% be the money that the government threw to companies? Could that all be in how they shored up the banking? Could it all be GDP, Treasury, purchased, FOMC, goobly gonk? Yes, it could be. And the real rates of growth could be, it could be all government growth. Funny money, funny accounting. I agree 100%. Maud, it's not without risk. Maud, would you just email me more on that $2,500 CAT scan risks, blah, 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 blah. Again, I kind of said I didn't agree with it. It's to that other gal who had the DNA blood prick test. Oh, it finds all that stuff and it was garbage. But if you could give me a little information, I definitely would love to hear it. As I went through and I read through this, I couldn't see it. I couldn't see it, so we're going to let the doctor give me some more comments on it. All right, what questions do you guys have? Any questions I can answer for you? We are very close. Next week will be a very light volume. Market closed on Friday, usually a half day on Thursday, or actually vice versa. Full day on Friday, full day off on Thursday on Thanksgiving, half day on Friday. No trading should be done on those 2 days. So we're very close to next week being a down week in our market, meaning retail traders, no volume, nothing you should be trading or worrying about. We will have Baidu next week, which is a little interesting. But very close to a holiday where this will be the final week for the month of high volume trading, maybe Monday and or Tuesday of next week as well. Any questions you guys have that I can answer for you? Going once. Going twice. William, I forgot. So William asked, because I made the comment, where are we going to put more money into right now? And I had a couple of thoughts or suggestions, but we're still pulling more money out. You'll notice a couple of you were in Pfizer. It's a loser. We're out. We're done with it. We can't get back in for another 31 days if we want to take the losses on the stock. We made up 3/4 of those losses with the puts. It just doesn't have the growth that we're looking for. It is behind on the obesity drugs, and it's behind badly. So Pfizer is not one that we're choosing to stay in. Square is very interesting. Micron is very interesting. But William, I'm caught in no man's land in our market. I'm caught in no man's land on individual positions. I'd rather stay a little cash heavy until we see the reaction from our last and final rate hike. And then I'd probably want to pile into some things at that time. So that's where I'm sitting at right now. I think we did add 100 Disney here recently. We did add 100 Bank of America here recently, but I'm not comfortable in throwing new money into a new position at this time with the uncertainty in our market. And I think it would be really hard to justify putting new money to work right now. You're welcome to send me an email and give me a run through of what you think, but I would just tell you that you don't want to be throwing good money at bad. And let me know if that answered your question. I don't see any other questions coming in. So, guys, I want to wish you a good evening. I appreciate you being here with me for this hour. I hope this hour was helpful. I hope this hour gets your questions answered on what we're doing and why. Again, you're always welcome to send me an email or, again, have a conversation with me. I know I talk to some of you quite regularly. Always welcome to have that conversation with me on what about this, what about that. I'm pretty much an open book, right? So appreciate you guys being here tonight. Maud, send me an email on what you think. Is it a fraud? Is it real? And guys, look forward to seeing you next Monday, just before Thanksgiving. And yes, we will not have a Thanksgiving trade findings and adjustments. That will be canceled. You guys take care. Appreciate your time. Look forward to seeing you next Monday. And have a good night, everyone. Bye-bye.